Hello, everybody. Welcome to the webinar today with Joe Duffy. We're going to be talking about how option floor brokers profit and how you can too. I do want to do a quick audio check with everybody. Make sure that you can see my screen and hear me. If you can, please go ahead and type a Y in the question box. That will help me understand that you can. Oh, perfect. All right. Okay, looks like everybody can hear me. We are going to be starting here in just a minute. We're going to wait. Looks like we have a few more people that are going to be signing on. It is 1:30. We'll be starting here in about a minute, so just hang tight, okay? Thank you very much. Okay, everybody. Thank you for joining us today. We are here for Joe Duffy's webinar on how option floor brokers profit and how you can too. I am the host. I am Michael McGinnis. I'm FFR founder and president. Today is Wednesday, September 14th. So thank you very much for joining us. We have a lot of people joining us today. We had a lot of registrations from all around the globe. And I do want to welcome each one of you today. So thank you very much for taking some time out of your day to be with us today on this webinar. Okay, I'm going to kickstart some things off here, and we'll just jump right into it. Okay. First and foremost, I want to make sure that everybody knows risk and knows about the risk. I'm sure you do. If you're trading in the markets, you know about risk, especially if you were trading yesterday on that side of it. It was a little bit brutal in the markets yesterday. But just want to put this up here, make sure that you do see this. We're in a highly regulated industry. We want to make sure that risk is well known. All right, because we are going to be talking about some trading and some aspects today for everybody. Okay, so real quick, just want to dive into a few questions that you can ask yourself. Not me asking myself, but you asking yourself. All right, so why am I attending this webinar today? Most of you, I'm sure you're not too bored at home. You've probably got a lot of stuff going on your plate, so you have a lot better things to do than be sitting here with us today. But the reason why you're probably here is because you're very intrigued. You may need some help in your own trading. Maybe what you need is a little bit of support in your own trading, and you're looking for maybe an edge that you could get as well. All right. What are you looking for? Well, that's sometimes we don't really know. You know, are we looking to learn? Are we looking to trade options? Do we want to do puts and calls? I mean, if you're new to trading, there's a lot of you're probably a little confused because you're on the internet, you're looking, you're trying to figure out where you want to be and what you want to do. Some of you may have been in the market for a long time. Maybe you're having some trouble with your own trading. Maybe you need a little bit of support. Maybe you need to recheck yourself, take a few steps back, and you don't really know what you're looking for on that side of it. So you're here today because you're intrigued about Joe's topic. Another question is, how can I improve? Some of us may know that, and we're just trying to figure out, you know, how you're going to get there. Maybe you don't really know how to improve on your side of it. Maybe you need some support. Maybe you need some guidance. You know, Joe's been in the market for 30 years. He may be an answer for you on that side of it to help you improve, to get better results. Apply your money management rules, figure what that is so you can take less losses and you see more profitability in your own trading. All right. And you got to look at, you know, and all of us do when we're looking at our journey with trading, is what are our goals? What do we want to accomplish within our own trading? Is it to see passive income? Is it to boost our retirement accounts? Is it to retire from our careers, or maybe we're coming up to retire and we want to make sure that we have something in place that we can put our minds to and have some residual income coming in from our own trading. So you got to think about your goals and what are those goals and are they attainable on that side of it. And then what steps are you going to take if your goals are attainable? You know, that's one thing you got to look at. You know, we've been in the business since 2006. Joe's been in the business since you know, for 30 years. And you know, there's a lot of people that we've ran across that have all these various different goals in their life on that side of it. Some of them are giving to nonprofit organizations. Some of them are giving back to their churches, or somebody are creating wealth on their side of it. Some are just very simple, help put my kids through college, you know, on that side of it. So those are things you have to think about, and how you're going to get there and how you're going to reach those goals with your own trading. Okay. So, you know, it is good that you're here today. We do appreciate that you are taking the time out of your busy day to join us and sit here, and hopefully we're going to be able to teach you a little something. All right. And you'll take something away from this. All right, so today's agenda, we are going to be reviewing who FFR is and what we do. When I established this business back in 2006, we'll give you an overview there. Introducing Joe Duffy. Obviously, he's going to be here today and joining us. Q&A session with Joe. Joe is going to go into some questions on some of the topics he's going to be going over today. So he's more than happy to answer all your questions. And if we don't get to them, you know, we'll try the best we can. We do have a lot of attendees that have registered and showed up today. So we'll try to get to everybody's questions as best as possible. Joe does trade in the market. He trades live every single day. He's very active in various different sectors of the market. He does have a couple of different opportunities and programs that he does offer to the retail client on that side of it. So we'll be going over some academics there and the educational course that he does offer, and see if that might be a good fit for you. Okay. Who FFR is. If some of you out there, you may know who we are, and some of you may not. But my company was established due to some very severe investments that I got into that I took losses on. And this was late 90s, early 2000s. And with me trying to do my research and my partners at the time doing some investing, we took a lot of losses. And there was a lot of stuff out there that we ran into that just didn't seem legitimate, you know, on that side of it. It was hard to find really what was true, real, and actually successful in working. Those were very, very difficult to research back then. Nowadays, you know, all of us, we have the good old internet, which is very accessible, but almost I feel it's even harder today, okay, for us to be able to do research. We're actually having to do fact checking on the fact checker. You know, the internet's very widely used by a lot of so-called gurus and legitimate traders that are out there to be able to connect with you, the individual that's looking on that side of it for help. But that is one reason why I started my company. I ended up going through a very due diligence process and coming up with an 8-step certification process to vet out these gurus that are on the internet, so I can find what is real and successful. We work with a lot of different traders on our side of it. Joe is one of our main traders that we've been working with, I think, for now over 5 years. And we do have other traders trading different sectors of the market, from Forex, futures, stocks, options, futures, commodities on that side of it. And we do look for individuals that have 15 plus years of experience. We want to work with people that have goals in place on their own trading, risk management tools, mechanical systems that are in place that are viable and well tested. Joe's been doing this for 30 years. He's very well known in this sector. He's got a great background with regards to trading, and that's why we've partnered with him. But that's our company. That's what we do. We vet out certain traders, and we partner with them. And then as they're trading and teaching their clientele, the people that have signed up with their programs, their main focus is trading and making money in the market and preserving their money and their capital. We are the connector. We find you, go through all the different aspects of the programs that these traders offer. And on top of that, we are going to be able to give you a very good understanding and educate you on how they work. Okay. On that point, it might be a good fit, it might not be. You might be suitable, your qualifications might not be there, you might be looking for something else, but that's what we do, okay, on our side of it. Okay. Who is Joe Duffy? Some of you, like I said, Joe's very well known with his experience and background being in this business for 30 years. He resides in Toronto, Canada. Yeah, he is Canadian. He's been trading for 30 years, like I've said numerous times. He's won numerous trading championships, ranked top 10, with seeing over 121%, 243, 432%. He was a 10-year prop trader for a major international bank. Previously ranked #1 analyst by the Greenwich survey during his career as a prop trader. Trades various different market sectors, currently trading options right now as well as futures on that side of it, which he'll be diving into during this webinar and going over some of the risk management applications that he uses in the market. He was registered as a CTA, exempt hedge fund manager. He does author many publications regarding trading and investing on that side of it. And Joe's retired from all of that. Now he gets to sit up there on his house by the lake and relax and do some boating, golfing, enjoying his family, and trade options for fun. He loves trading options. He's not that old. I think Joe's around 55, 57. So he's not that old. But he's been very successful in his career. Okay. All right, I am going to now jump into and turn the floor over to Joe. He's going to be talking about how option floor brokers profit, how you can too. He's going to give you a little inside tip that he's learned throughout his 30-year career. He's going to show you how to reduce risk, win more trades, even in a bear market, even in the market conditions we saw yesterday, everybody, which was horrible. I hope none of you lost too much money in the marketplace yesterday. It was just devastating. Yesterday, we did have some success. We were on the right side of the market with Joe on that side of it. And the clients that we're currently working with that work with Joe are seeing some success as well. Didn't see any losses yesterday. All right, Joe, are you there? Are you tuned in with us?
Yep, I'm here, buddy.
All right, perfect. All right, welcome. Thanks, Joe. And what I'm going to do is I'm going to go ahead and give my screen and control over to you. So just bear with me here. All right. Okay, you got the control, so I just gave that to you.
Okay.
All right.
Okay.
Perfect.
I can still see you, so I just gonna.
Yeah, I got me. I'm on a web, so I'm gonna go ahead and take me out of there. All right, so perfect. I can see your screen perfectly. And if everybody else can see the screen as well, just type in a yes. I can see it. I want to make sure that everybody else on here can see the screen as well on Joe's side. Yes, perfect. All right. Darren says yes. You're good to go, Joe.
Okay, guys. Thanks, Michael. Thanks for coming, guys. The floor trader part of this, I want to discuss in two different points. First of all, the floor trader's job, let me describe what it is and then how we can use the same principles in our trading, because that's really what we're talking about here. So the floor trader's job is to make a market. And by that I mean, if an institution wants to come in and buy 10,000 options on Apple, because they want to hedge against the stock going down, for instance. So they buy $10,000 or 10,000 put options because they're long, 1 million shares of stock, say. Now, obviously, there's not going to be somebody on the other side who's a retail guy or somebody like that willing to provide a 10,000 lot option trade for them to trade the other side of. So that's why you need the market maker on the floor. He will price those 10,000 options and sell them to the institution. Okay. Now, what is he now? Now he's at risk, obviously, because he's short 10,000 put options. So what does he need to do? Well, he needs to be short the stock, right? So he will, if the option is priced such that $1 down move in the stock will move the option, 50 cents, he'll use that 50% ratio and he'll short half as much stock as he has options. Okay, so that's how that works. Now, this process used to be on the periphery of the market, in the sense that the stock market was the real thing and the options were the tag along or the tertiary market. But what's happened, and this is the market's so changing all the time, and this is one of the things that's been the big change in the last few years. What's happened is there's been so much option activity, not only an increase in retail option activity, exponential, but an increase in institutional option activity, to the fact that there are now more dollar value traded in options, or dollar value traded in the options the stock represents, than there are in the actual stock. Okay, now that's really important because it affects everything. And let me tell you why. In the example I just gave you, where the floor trader has to be, he's made a market for the institution, so now he's short 10,000 options, so he has to be short, 500,000 shares of stock. So he has to go in and sell 500,000 shares of stock. So now he is hedged with his options trade. Okay. Now, obviously, selling 500,000 shares of stock puts a little bit of pressure on the stock. Now, if the stock continues to fall, remember I said the option may fall 50 cents for every dollar the stock falls. But as it continues to fall, he's going to have to sell more stock to cover his position in the options. Okay, so that he is what they would call delta neutral, that he is hedged, that he's not going to lose money being short the options because he's also short the stock. Okay. Now, as you can see, this can be almost a self-fulfilling prophecy. If the market starts to roll downhill a little bit, all the option traders who are short those options have to start selling more stock, which pushes the stock lower. Okay, so that has become a real thing in the market, and it works both ways. It can work in a bull market too, where the option trader is short the calls and has to buy the stock. It can tend to push the market up because there's so much of that going on. Okay, so much of it going on. Actually, more dollar value is being created due to covering option positions than it is just straight buying and selling in the stock market. So we've become to a situation where the tail is wagging the dog. The more option trading there is, the more hedging there needs to be done, the more it's pushing the stock market one direction or the other. Okay, so that's an important thing that's only happened in the last few years. Now, as I describe that, you may ask, well, how does the floor trader make any money? Because he's short the stock and short the put option or whatever. How does he make any money? Well, he makes money because each option has a time value. Now, I'm sure if you're a bit familiar with options, you know what I mean by time value. That means if XYZ stock is $100 and the option that expires in 2 weeks is priced at $3, and the stock's $100 right now, the option strike price is $100, that option actually has an intrinsic value of 0 because it gives you the right to buy the stock at $100. The stock is $100, so it's intrinsically worth 0 right this moment. But you may be buying the option or selling the option for $3, okay? So that $3 is the time value left to expiry. Now that's where the floor trader makes his money, okay? Because as the option gets closer to expiry, that time value will decay. So if he's selling $3 options today, for 2 weeks from now, every single day that goes by and the market stays steady, in a hypothetical example, that option would decline in price because it has less time to expiry, so it has less time value and more time decay, okay? So that time decay is the thing that we're going to talk about today, because that's the principle that we can use as individual traders to make money. Now, I want to urge some of you right now who may have thought in the past, well, geez, options was hard enough to figure out. I am just going to stick to puts and calls. I'm going to implore you, and there's nothing selfish about this. I'm honestly doing it with the most altruistic intentions. If you can understand how puts and calls work, you can understand how option spreads work. You're 80% of the way once you understand options, okay? Understanding how spreads work is another 20%, and it's well worth the time, the small amount of time that you'll invest in it. I know for almost all of us, and I know for me, when I started learning about options, it was a little bit confusing. I had to think it through, write it down, say, okay, if it's going to go here, what's going to happen? And it took a while to actually understand, for me anyway, how options were going to perform given certain scenarios, and I had to do it with a pen and a paper. And the same is going to be true probably when you start option spreading. But if you understand puts and calls, I implore you, don't throw up your hands and say, oh, you know what, puts and calls is good enough to me. This spreading and all the crazy names they call it, it's too confusing for me. I would suggest or implore you not to do that. I've heard that among retail clients say, oh, it's too confusing. I don't need to know all that. I just want to do puts and calls. Well, you're going to throw your money away to an extent that you don't need to, if you understand the advantages that you can be gained in a lot of cases from spreading. Now, will I ever buy straight puts and calls? Yep, because there are situations that warrant it. But a lot of times that spreading is the way to go. And why do I say that? Well, we're going to go through the reasons, but better risk control. The better risk control becomes you're always short something and always long something, just like the floor trader, okay? He's spread between the stock and the options that he's short, okay, all the time. So his risk is hedged, it's mitigated. And that's what we're gonna do with option spreading. Now, it's a much smoother equity curve because you are hedged. So you're not gonna have the wild gyrations of that you would have if you just long straight puts or calls. If you could imagine in the floor trader example that the floor trader did not hedge his bets, he wouldn't last eventually as a floor trader, but you could imagine how wild his equity curve would be with the gyrations in the stock if he just tried to stay naked, the short options. Now, because you're just like the floor trader, because you're trying to take advantage of time decay and you're hedged, you're long something and you're short something, you're going to have a higher win percentage because you're taking advantage of that time decay. And that time decay is always going to work in your favor. Let's look at it this way. Let's take something that we say is an out of the money option. Okay, we did an option the other day as part of a spread on Square, the company Square. And the stock's around $70, I believe, and we sold a 65 put for I think $1.25 or something as part of a spread that expires next Friday. Okay, so the stock is $70. We're selling a put that's $1.25. That means the stock is going to have to drop below $64 by next Friday for that stock to be worth anything, for that option to be worth anything. right? So it has to drop $6 by next Friday, 7 trading days, in order for it to be worth anything, that option, right? That's about what, I'm trying to do the math here, maybe that's 8% that stock has to drop, right, by next Friday. How often do you want to take that bet by buying that option? If the stock has to drop 8%, do you want to be buying that option, or do you want to be the one selling that option? But obviously the answer is you want to be the one selling it, because the vast majority of the time, that stock or any other stock is not going to drop 8% in 7 days. It's just not going to happen. Now, you may go, oh, well, what if it does that one time and it drops 30%? Well, that's why you're hedged. You'll still make money, even if it does drop 30%, because you've got another position that will allow you to make money. So you're still going to make money. So you're just like the floor trader. You're taking advantage of the time premium in the option that expires, in the short run. Okay. Now, so what the floor trader does is he makes his money on time decay instead of paying it away. So when you say, or I've heard retail clients say this many times, oh, do you know what? Puts and calls are good enough for me. I don't need to know all this confusing spread stuff. You're the guy who's paying away the time premium all the time instead of the guy who's collecting it. Okay. So which guy do you want to be? The guy who has a very high chance of winning, who's done the little bit of extra work to figure out what all this spread trading is about? Or do you want to be the guy who continually says, hey, well, it's too confusing for me. Just let me gamble that I'll pay this time premium away all the time, and that I'm going to be right often enough that the market's going to move 6% before expiry. I don't want to be that guy. You really can't make money like that. Okay, so let me show you the very important chart here that's going to be that's the basis for what we're going to, without everything that what we do. Okay. This shows the non-linear time decay of an option. Okay, so an option that expires next Friday. Remember, I gave the example of Zoom. We sold some options from next Friday that were, $7 or $5 out of the money, and we got $1.25 for them. But the time value on that option is going to be on the very right-hand part of the curve, and you see how exponential it goes. And why? Well, because that stock has to drop, 7% or 8% in 7 days for that option to catch up to what you paid for it before expiry. Okay, so you don't want to be the guy trying to hope it catches up. You want to be the guy who's short that option, saying, hey, see how many times you can catch up. It won't be very often. And so you're just going to bank that 1.25 time and time and time again. Now, how are we hedged? Well, we're hedged. This is a little bit different than the floor trader. How we're hedged is we have an option that has a longer expiry. So if we go to the left-hand part of this curve here, you can see the time decay on a long-term option, and see that line is barely below horizontal. All right. So while in that week where this on the very far right had the exponential almost straight down time decay, the time decay on our long-term option was just a little bit below horizontal. Okay, so that's the concept that we need to take advantage of with the spread. Okay, it's so important to do things this way with options, especially now with volatility so high in options. Premiums get out of whack quickly, and it's really nice to be able to sell those out of whack premiums rather than having to fight them by buying them. Okay, so this chart summarizes everything that I like to do. Right here, the long-term option decays slowly, the short-term option decays quickly. Okay, that's it. So we want to be long a far out distant month option, and we want to be short something that expires in a week or two. All right, that's what we want to do. There's various ways we can do that, but that's how we want to do it. Okay, so a spread is essentially like a covered right. Now, hopefully some of you may be familiar with a covered right. That would be, as an example, you own 100 shares of Apple, and the stock's, $150, you could say sell an option to sell the stock at $150 in a month, and you may get $6 for that option. Okay, and what that means is you get the $600 if you write one option against your 100 shares of stock. However, if the stock goes up and above 150, you're going to have to sell it to the owner of that option for $150. But you do get to keep the $6, so you're essentially getting $156 right now, right this second, for your $150 stock. Okay, so that's a covered right, and some of you may have done them. Essentially, that's what we're doing, except in our example, the long dated option takes the place of owning the stock. Instead of owning the stock, we own the long dated option, and we essentially write a short dated option against it. Exactly the same principle as you do the covered right. Okay, so again, we own the far dated because why? Because the option time decay on the long dated is slow. We sell or are short the near dated. Why? Because the time decay on that option is exponential. Okay, so the key takeaway, time premium always erodes faster on the short dated option than it does on the long dated option. Now, let me just pause here for 1 sec. I've tried to go through this as clearly as I can, but I'm an ad lib talker, so if I haven't made it clear, I'm going to kind of just pause and see if anyone has any questions, because it won't pay me to go further if I haven't done a very good job explaining what I wanted to convey so far. So if there's any questions, please just raise your hand or type it in the box, or hopefully Michael can pass it on if he sees it before me. So I'm just going to wait like 20 seconds here, or just if you want to type and let us know something's coming, just send just a sec. Or
Yeah, Joe, if anybody's got any questions out there that is that's following along, right now would be a good point, good time. So I'm looking at the question box, Joe, and seeing if anybody's got anything.
okay, well, maybe I've done a decent job explaining it then. That's good.
Yeah, maybe everybody's following along perfectly.
Okay, good. Okay, perfectly. Okay.
Yeah, and then everybody, just so you know too, we got Darren. Darren says makes sense so far. Thanks. We got somebody here. Chris says, how do you decide which stocks to put the spread on? So maybe that's going to be down the road in your webinar here.
Yeah. Well, that's probably another webinar. I'll touch on it. Okay, it's a good question, and I will touch on it because there are different strategies that I use for depending on how bullish or bearish or neutral I may feel on the stock. So we are going to actually touch on that a little bit, because I do have a couple of strategies on right now that are more bearish, and one that's sort of more neutral to slightly bearish. So we will touch on that to some extent. We'll at least let you know which strategies work best for each.
Okay, and then
okay,
hey,
so,
Joe, we do real quick, Joe. Sorry, we did have another one that popped in here.
okay.
One of them says, so you would sell Apple, just for an example, as a short-term option to expire in 4 weeks, and place a long-term call on Apple for like 3 months out.
We're exactly right. Exactly right. So you might sell, and in fact, we're just going to go through it right now. And you can substitute Apple where I've written SPY here. You could buy a December 160 call on Apple and sell a September 160 call on Apple. And that would be an example very similar to a covered right, where instead of owning the stock and writing a short-term call against it, you own the long-term option, or actually the long-term right to buy the stock and sell the short-term call against it. So again, why do we do that? Well, because option time decay is exponential on the short one and much slower on the long one. Okay.
Hey, Joe, one other question to that as well, as a follow-up with somebody else. They're asking, isn't a longer option more expensive?
Well, it's more expensive in absolute dollar terms, yes, okay? But see, what will happen is this. Well, let me go through this example, and I think it's probably going to answer your question, okay? So
Okay,
let's say
perfect. And then everybody else hold your questions, and then Joe, we'll, after you're done with your webinar, we'll go ahead and answer all the other
yeah,
questions
so
that do.
even after we're done this slide, because I think it's important, I don't want to lose anybody. So I'm going to go through this slide here, explain
Perfect.
this, and then we'll go back to the questions, because if it doesn't answer them, that's the perfect time to go. So we could even substitute the word December or November for October here. It doesn't really matter, but let's take this long-term call we have, you know, at $5, okay? Now, and then we sell one that expires next Friday for $2. Okay, so our net cost is we have to pay the 5, remember, because we're buying it. And so yes, you're 100% right. They are more expensive, clearly, because you have a lot more time. So they are more expensive in dollar terms, but they aren't more expensive in dollars per time left to expiry. Okay, if you can understand that concept. If this thing has 90 days to expiry, you know, I'm just going to pull the numbers out of my hat here, but it might decay in a linear fashion. It might work out to the time value being, you know, 15 cents a day. Whereas this one here, the one you're short, has a much shorter time to expiry. It probably declines at a rate of 40 cents a day. Okay, so if you were to do a linear calculation for the time value of the option um, versus the amount of time to expiry. Okay, so yes, in absolute terms, the long dated option is clearly going to be more expensive because it has more time left in it. Okay, and that is obviously a factor, but what we're really after is that exponential decay in time value, which is on the short one. So if we did an option like this, where we bought at 5 and sold at 2, it was only going to cost us $3. Now, let's look through the scenarios that could happen here. Okay, in this scenario, we're kind of neutral. I'm kind of thinking that that the market's probably going to stay a little bit neutral. So if by September 26, the market happens to stay at 400, this $2 option, okay, is going to be worth 0, because if the market's at 400 and the option's at 400, it has 0 value. So now you've got an October call that you paid $3 for. That's probably going to be worth maybe $4.30 or something, okay? Because the option premium on this one, remember, is going to decline much more slowly than this one. So where this one loses the whole $2 in value as the market stays still, this one may lose 70 cents in value. Okay, so you make 2, you lose 70, you've made $1.30 on a $3 investment. Okay, now that's if the market stays still. If the market were to roar ahead to 405, you know, this one may be, you know, 750 maybe, and this one may be maybe $8, and this one would be $5 ready to expiry at 405. No time value left. It's worth $5 if the stock's 405. So this one was say 750. This one's now $5. The difference is now only 250, but you paid 3, so you're losing 50 cents. However, you buy this one back at $5 and you can sell the next one. The next one's going to have more time value again. So you buy this one back at $5 and you can maybe sell another one at $5.75 or $6, okay? Still against this long dated one, okay? So now your net cost is down to $2, okay? Because you're buying this one back at 5, selling another one at 6, your net cost is $2. Now, if the market turned around and went back to 400, you'd be even in better shape, because that one you just sold for $6 would go to 0. This one would probably go back down to 3.5, and your net cost of 2 would now be worth 3.5. Okay, and all this is just solely dependent on the fact that the long-term option declines at a lesser rate than the short-term option. Okay, now it's a really excellent point. Somebody asked, you know, do you still have to have some sort of opinion on the market? The answer to that is mostly yes. And when I'm going to explain what I mean by mostly, I've seen this exact strategy here, where price anomalies in the market, um, due to, I guess, the short-term volatility can make people bid up the premiums for the very short-dated options. So I've seen opportunities, and we've actually traded them, where the market gets really, really, really volatile. And what happens is this short-dated option gets really, really, really bid up. So the 400 call, you know, maybe go up to $5. Say this September 26 went to $5, and I could get one that's 8 weeks out for $10. Okay, so that's an almost can't lose situation, because I've longed something for $10 that's got 8 expiries to go, and I'm short the nearest term expiry for $5. I've recaptured half of my premium that I paid for that option that has 10 weeks to expiry, just by selling one option that has 1 week to expiry. And the only reason I'm able to do that is because the market got out of whack, because people started chasing premium, because the market was volatile. And where do they chase premium? They don't chase it 10 weeks out. They chase it 1 or 2 weeks out, or sometimes even less. Okay. And we've actually done trades where I can sell an option that expires in a week for 50% of the value that I can buy an option that expires in 10 weeks for. Now, it's never impossible to lose in the stock market, but when you can find an anomalous trade like that, it's almost impossible to lose, because you've just sold a very inflated short-term option. And not only that, you have 7 more chances to sell options against it before it gets to the expiry of your long dated option. Okay. And you've already recovered 50% of it in your first try. So you've got 7 more tries. Well, do the math on that. If you recovered 50% on your first try and you got 7 more tries, what are the chances that you're going to be able to recover whatever spread this was, plus a whole lot more? They're very, very high. I can tell you, they're very high. And once in a while, you'll find this. And in those kind of situations, you really don't need to be that opinionated on which way the market's going. All you're doing is taking advantage of anomalous price action that's happened when they bid the short option up. Now, generally, this kind of strategy here will be great in a market that's kind of being choppy and sideways, right? Because the longer it stays around 400, the better it is for you, right? If the market was to precipitously fall or precipitously rise, that $3 spread will narrow somewhat. Okay. Now you have more chances to sell against it to regain it, but generally this strategy will be best in a market that's chopping around and going sideways. So that's one strategy I use. It's called a straight calendar spread, and normally I would use it mostly when I see the short-term option is very highly priced vis-a-vis the long-term option. Okay. Now I gave you an example where we actually did one that was worth 50% with a week to go versus an option with 10 weeks to go. That was only twice as much. That's almost giving you money. You don't see those very often, but if you can get them even a third or so, I will do them, because you have 7 more chances to make up this premium by continuing to sell the short-term option. And every time you sell a short-term option, you're going to collect the time value against it. That time value will go to 0 by expiry. It's absolutely must. So if the stock, say, went to 402, you had to buy this back at $2. So you didn't make any money or lose any money. But now this option here has gone to 6.25, and you get to sell another one. So if you sell a 400 again, you may sell it for $3. That's a $1 time premium. Okay, you're making money on this one, and you're selling another one that has more time value in it. Okay, so you've now set up the exact same spread, except now your net cost is down to $2. So that's how you make money in those kind of strategies like that, by continually picking up time value, okay? And when we say your risk is controlled, you can see how, because even if in a worst case scenario, you can't sell enough time value between now and when this option expires, you're going to sell some time value. There's always going to be time value in the option. So the question is, it's a race to make up this $3, and then over and above that is profit. So if you make up $1 every time and you've got 7 chances, you're going to make $7. But you know, if sometimes you're only going to make 50 cents, it's going to be harder to get back to that $3. But you're always going to be getting something, right? It's not like you're going to be getting nothing. So you're always going to be chipping away at that $3. And say in a worst case scenario, you chip it away down to 75 cents. Well, you know what? You lost the 75 cents because that's all you could chip away to. All right. So your $3, you know, became, you know, $2.25. So you lost 75 cents on it. Right? But you're always going to be able to chip away at it. And that's why your risk is controlled, because it's not like it's going to go to zero. You're always going to get something every week. So when we put on this spread, this number here, the difference is what we need to chip away at by continuing to sell time premium, okay? Every single week that we sell, there's going to be a time value in an option, and that's going to chip away at that $3. All right, so that's one of the kind of spreads that I will do. And that spread can be dependent on 2 things. Do I think the market's going to discontinue trading a chop, or more likely I see a situation where I think that the short-term option is overvalued vis-a-vis the long-term option. That is, you know, in the example I gave again, if this option were $2 and this option were $4, well, very hard for me to lose money on that scenario. Yeah, even at 5 and 2, it's very hard for me to lose money in that scenario, because I'm going to have 6 or 7 more chances to sell time value. Okay, and I'm getting $2 of time value the first time. I only need to make up $3 of time value in the next 6 or 7 expiries. Okay, so that's how we take advantage of time, and it's also how we control risk and limit, you know, getting killed, because we're always making something. Even in a bad trade, you're going to chip that down. You just may not chip it down to a profit. Okay, here's another one that I like to do, and this one requires a little more directional view. And I have no problem with having a directional view. When I say directional view, I mean, okay, I'm going to position myself to be slightly bearish or slightly bullish, or very bullish, or very bullish, or very bearish. So the calendar spread, again, we use the same strike price and different expiry. Okay, and we went through how many chances you need to sell against the options to, you know, to recoup that $3 in time value to break even. Okay, the diagonal calendar is one of my favorites that I like to do, and it's a little bit more weighted towards I have a view. Okay, so I'm going to let me. Okay, we'll just stay here. It's more slanted. So in this example here, I'm going to buy an October 31st 400 call because I think the SPY's going up. And actually, we're actually positioned the other way right now, but it doesn't matter. This is just an example. So I'm going to buy that at $5. Now I'm going to sell one that expires this week, and it's a 405. So notice before we were using 400 calls and 400 calls with different expiries. Now we're using 400 call and a 405 call with different expiries, okay? So I'm gonna buy the long dated still for $5, but now I'm gonna sell the 405 call. So it's out of the money. Again, if the SPY is 400, this 405 call won't be worth anything until the market gets above 405. And if it gets above 405, my $5 call is gonna be worth, you know, $780 or $770 or something like that. And you know, right at 405, this is still worth 0. So I can actually make money on both halves of this spread. If the stock goes to 405, This one, the top one, goes to 470 or 480. This one goes to 0. Okay, so I've actually made an extra 75 cents for doing nothing other than giving myself some protection. All right, so if it expires in below 405, I have another chance again to reduce my cost. So instead of buying this options for $5, I sell the 405 against it for 75. Now it costs me 4.25. If the stock goes to 404, this expires worthless. This has gone up in price because the stock's gone up $4. Now I have another chance to sell another option, a 405, a 407, a 403, whatever I feel like, and collect some more time value while I already have a profit in this one. Okay, so you're just locking in more time, more profit, while you're taking advantage of time decay by selling an option against it. Okay, so this is a much more bullishly slanted strategy because you're buying a 400 but selling a 405. Okay, so anything below 405, this thing goes to 0. Okay, well, let's say it goes to 410. All right, let's say a really big rally and the market goes to 410. Well, this one, the bottom one's now worth $5, right, at expiry. Difference between 405 and 410. You only got 75 cents for it. Ouch, you just lost $4.25 on it. Ouch, ouch. Well, not really, because this one, the $5 one, is probably now worth 11. So yeah, you lost 4.25, but you made 6. Okay, so you still made money. All right. And that's on an outlying kind of move, right? If the market just makes a kind of a little bit smaller move and moves to 405 or 404 or 406, you're going to do well on this, right? And then have the opportunity to sell again. But there's really even a big upside move is still gonna make you money. So you're not really cutting the legs out from under yourself. Now, if you're wrong and the market starts to go down a little bit, this does afford you a little bit of protection, okay? Not a whole lot, but it does provide you 75 cents of protection that you wouldn't have had you just bought the call straight outright. Now, there's other things you can do. Once I'm in this spread, I said earlier that flexibility is one of the greatest things we have with option spreads. I can change this spread around. I don't have to leave it here. We've done this with a PayPal trade just recently. I set up a spread, and then you know, let's say this one expires at and I collect the 75 cents. And then I'm looking and I'm going, well, you know what? I'm not quite as bullish on the market as I was. So instead of selling the October 3rd 405 call, I may sell the October 400 call and change it back into that calendar spread again. And, you know, I may get, you know, $3 for that. So now my 4.25 net cost is down to 1.25. So there's a lot more flexibility to change your position around without having to eat a loss on it. So I can be in this spread and change my mind, okay, and which way the market's going to go. And if I'm in a straight put or a call, I'm going to have to just eat that trade, get out of it, and you know, take my loss. But when I'm in a spread or a hedge position, I can lift this leg of the hedge and change it into a little bit different kind of a hedge, a little bit more bearish, a little bit more bullish, a little bit more neutral. I can do anything I want. And why would I want to do that? Well, because I can take advantage of the short-term erosion of time value in the short-term option. So that's going to continually mitigate things that can go wrong. Now, sometimes things can go wrong, or to the extent that not every spread you put on is going to lose money. I mean, if I put this spread on here and the market just tanked like a son of a gun, I'm still going to lose money on it, right? Now, I can mitigate some of the loss by continuing to sell against it, but if the market's tanking and I'm along a bullish spread, then, you know, I'm going to be underwater, okay? I'm not going to be as much underwater as if I was just long the straight call, but I'm still going to be underwater. But I'll have the chance to, you know, to mitigate that loss by selling something else against it, okay? So I'm not saying that this is the perfect strategy you can't lose on. I'm saying that it takes the greatest advantage you have, say being a floor trader, taking advantage of short-term option decay and puts it in your favor. It's so much, it raises your probabilities of success so much and mitigates your risk and smooths your equity curve so much. Okay? It's just, it's a much better way to trade than the all or nothing sort of a mentality of puts and calls where you're continually fighting the time premium. Okay, I don't want to fight the time premium. I want to be the person that sells to the guy fighting the time premium. Okay, I want to be the house. I don't want to be the gambler. Okay, so that's how I trade options. I've got a couple up here that this. Let me go to my my trading screen here and see if we can. Sometimes Interactive Brokers shuts me down. Okay, we've still got our options up here. Okay, so this is an option that we bought yesterday, and it's not much changed from where we bought it yesterday. I think we paid $345, and it's 357 right now, so it's not much changed. But we were on the puts here on the side. So what we did was we bought the October 7th long-term option. In this case, what I was a long-term option. You can see where my cursor is here. We bought those for $4.70. Actually, this is what they are today, $4.70. And we sold the 75, no, what did I sell? The $75 option for $1.13, okay? So listen, this is $1.13 we're getting as of today. This has 7 more trading days, Thursday and Friday of this week, and 5 days of next week. We're getting $1.13 for it right now on the bid, so you're probably getting a little bit more than that. But let's say $1.13. The stock's $80, so it has to move below $69. Okay, sorry, below $74. Excuse me, below $74 by next Friday for this option to be in the money. The stock's $80 now, so it needs to make a $6 move just for this buyer of this option to make money. Okay, $6 divided by 80 is whatever that is, 7% or more. Okay, so this stock has to move 7% by next Friday for this guy to make out. Do I want to be a seller of that option, or do I want to be a buyer of that option? You know, if you are continually giving people the opportunity to bet on a stock moving 6% in a week and a half, you take that opportunity all day. So that's essentially what we're doing here. Now remember, if this stock, if the buyer happens to be right and this stock does move below $75, well, we're long the $80 put. Okay, so that $80 put, if the stock moves to 70, is going to have an intrinsic value of 10 plus whatever value it has, for time value. So we're still making good money on that spread. But if the market doesn't move down 6% in a week and a half, then we're just going to collect this $1.13, and then we're going to have the chance to look and say, do we want to sell, the September 30th options? Okay, so the spread is inclined bearishly, but I'm short a leg here that is going to decline exponentially, whether the market goes down or not. Right? So I want to sell this guy an option who's willing to pay me $1.13 or $1.20, and he's betting that it's going to move 6% in a week and a half. I'm going to be the other side of that bet all the time, especially if he's right. I'm still going to make money, right? So that's the principle of how we set this spread up. It's an exact spread I have on right now. I'm long the long dated 80 put and short the 75 put on Zoom. If the market moves sideways to lower, that spread will get bigger and widen. That will move in my direction. If the stock moves down, the spread's going to get wider even more rapidly. Okay, so this is an option that is tilted toward the downside. okay, for sure. So that's how, rather than just buying a straight put or a call, hopefully you can see the advantage of taking a long dated put and selling a short dated put, because we're going to get $1.13 for something that's very, very unlikely to happen. And even if it does happen, we're still going to get paid. Okay. So that's the principle of how the floor works. They basically make money on time decay, and how we can use it to our own advantage. And there's not a lot of talk about spreads in the market, and I've heard a lot of people say to me, even or in text conversations, well, you know what, I'm just, if puts and calls are good enough for me, it's fine, blah blah blah. Well, I'm going to implore you to try to take the little bit of an extra step and understand how spreads work, because don't be the guy who's trying to pay $1.13 and hoping the stock moves 6% in a week and a half. Don't be that guy. Be the guy who's selling to him. Okay, be the guy who's selling to that guy. All right. And if you understand how the spread works, you're going to, like I said, you're going to have tons more flexibility in rearranging the spread rather than just eating a loss. You're going to have a lot more chances to mitigate your loss, and you're going to smooth your equity curve. And that's to me the best way to trade options. I think there is a place for straight puts and calls, and I will occasionally do straight puts and calls, especially on stocks that that option premiums aren't large. I've got a few that option premiums don't tend to be large, like DraftKings or Starbucks. Option premiums don't tend to be large on those stocks, so they are good candidates for straight puts and calls. But largely on options on stocks that have large premiums like Zoom, or like Square, which we're also short, these kind of spread strategies work great because you're getting such huge premium for very unlikely events. And even if that 1 in 10 times that event comes true, you're still going to make money. Okay? Why not take advantage of it? Don't throw your hands up and say, oh, puts and calls are good enough. They are. This is a much better way to trade.
Hey, Joe.
Yep.
I'm gonna chime in here. We're at the 1 hour mark for our amazing webinar, and you're going over some very interesting strategy here. How much more time do you need? Or
No,
can
I'm good, buddy. That's it. That was all I wanted to talk about. Yeah. Yeah.
Okay. Yeah, we're gonna go. Let's answer some questions, Joe, because we do have a few that came in. Some of them came in on slides 4 and 5.
Okay.
I'm gonna go back here. We had one from Carolyn. She actually had a few. Number one, she wanted to know if your strategy works in high volatility. Number one, if doing spreads on the side of it would work in high volatility.
The answer is yes, Carolyn, because what happens in high volatility can actually work better. Because during high volatility, what happens is people get more emotional, and when they get more emotional, what do they bid up? They don't bid up the long dated contract. They're not having any patience for that. What they bid up is the short dated contract, right? So when volatility is high, emotions are high, premium gets built into the short dated much more so than the long dated. So it's actually great in volatility because you'll get higher premiums in the short dated, which were short, vis-a-vis the long dated, which were long. So yeah, in actually volatility is great, because like I said, what usually happens as a rule, the short dated options, the time value expands to a much greater degree than it does in the long dated options. So volatility is our friend in spreads.
Perfect. And then you've probably covered this, I think you did, but can put spreads act the same way?
100%.
Yep. Okay.
100%. And the option strategy I just showed on Zoom was using put spreads.
Yep.
But
And
I used calls in this example here because most people think in calls. So yeah.
And then Carolyn also wants to know, are these calls at the money?
It depends. Like you can slant it any way you want, Carolyn. Just in that Zoom trade, like I did, I took an at the money option for my long dated, but I sold an out of the money option for my short dated. You can slant it any way you like. It depends on the degree of bullish or bearish that you are. I think the strategy that I have on Zoom is reasonably bearish. So I'm expecting sometime in the next, 2 or 3 weeks that we are going to continue to accelerate lower. So is a little bit more aggressive. We were long last week, but with much less aggressive positions, much less aggressive. So I'm much more aggressive here at the downside than I was last week when we were long. So
Right.
I can slant that any way I like.
Perfect. Thanks, Joe. And then also Terry asked, and this was when we were on slide 4,
Okay.
do you roll the short option with a call price again at 400?
Yeah, you can, Terry. It depends on how we feel at the market about that time. Again, flexibility was one of the great things that we talked about with option spreads. And I've got a PayPal spread on right now that last week had a slightly bullish flavor to it, was making money. And then I kind of looked at things and I said, hey, you know what? This is far enough. I'm going to change this to a slightly bearish flavor, which is what I did. So there's tons of flexibility. So after this September 26th were to expire, yeah, you could do anything you wanted. You could sell a 400, you could sell a 402, you could sell a 398. Again, it would depend on how you felt about the market at that time. So you could really, in a sense, reslant your trade after already pocketing the short-term time premium here. All right. So the amount of flexibility it gives you over just saying, well, I'm bullish by a call is immense. Yeah.
And we do have a lot of other questions that are coming in, and there's probably going to be more questions than we can actually get to. There's a couple here, and it's actually, this is something I was going to pose, Joe, because I'm sure this is going to come up with some of the viewers today that are on the webinar, as well as some people that will watch this after the fact. But do you think, some people on this webinar are going to ask, hey, how can I learn this, and how can I learn how to do this, and can I learn it from basically you directly, in this specific strategy?
Well, yeah, I mean, I think you learn as you go by watching it. You still, the actual mechanics of the strategy, you can certainly learn. Yeah, absolutely. The mechanics just take practice and it's not that complicated, and it soon becomes second nature to you. It's just at first, the same as I did when I started doing this, or the same as we all did when we started puts calls, we kind of had to write it down on a paper and sort of think it through a little bit, right? But yeah, you can learn this. It's very simple math. It's just adding and subtracting. Yeah.
And then one last question, then I'm gonna and then we'll get to all the questions after the fact. But can this be applied to index trading?
Oh, absolutely. Yeah,
Like,
1,000%. Yeah.
okay.
And sometimes index trading is great for it because premiums in individual stocks generally tend not to be quite as high as they do in the indexes. So I will always look at the indexes to see, how are my short-term premiums looking in the indexes, and how are they looking vis-a-vis the long-term premiums. And do I feel more comfortable in an index than I do in a stock? In the instance of Square and Zoom, which I'm short right now, I mean, Zoom's pretty close to the lows for the year, so it's having a heck of a time getting up off the ground. And the Square had a miserable day today, even though the stock market tried to recover. But yes, the answer in indexes, it can work very well because option premiums tend to be higher in indexes than they do in individual stocks.
All right, perfect, Joe. Thank you very much. Hey, I'm gonna go ahead and take back over control and go over a few things with everybody so they have an understanding of what you do on that side of it, give a little bit more detail on more of your background and your programs, and give the audience some in-depth understanding of some of
Right,
the other things that you do as well.
right.
So
And
you can
Michael,
go
sorry, just
ahead.
one last point. They can email me questions as well. If they want to email me, I'll just answer the question. There won't be anything else involved.
Yeah, perfect. All right, thanks, Joe. All right, so
Okay.
everybody, I'm gonna go ahead and take back over the screen here, and everybody, You should be able to see my screen. We just went over a Q&A session with Joe on that side of it. I do want to let you know, and he did mention his target zone program. We're in a couple of trades right now with Zoom, he mentioned as well. That's his spread trading strategy. We've been working with Joe on that for, I don't know, a little over 5 years now with target zone. He's also got, he did say he does trade puts and calls when the time permits. He does have a strategy called Key Point that he does apply puts and calls to on certain stocks on that side of it, buying options, not selling options. His Learn and Earn educational course, just so everybody knows that Joe does, like Joe said, he does teach his strategy. His service details is he does apply, if you are interested, he does apply the ability to give you the direct alerts, whether it's your email or your cell phone, daily market position recaps, keeps you updated and educated on that side of it. He does give you education on the methodology and the rules that he does apply with his spread trading of what he was teaching today. Every day as well, he does do a video commentary. Those videos could be anywhere from a few minutes to 15 minutes on what's going on in the market, where we're at in the market with the positions, and why we're in those positions and what we're looking at. Okay. There are third-party brokers out there. For those of you that are not don't have enough time to trade during the day, maybe you got jobs, you're busy, you got to take care of your family on that side of it, careers, running businesses. There are third-party brokers set up that are receiving the signals currently right now. And you got access to me and my company when you do get involved. Joe is also throwing out with his service the daily Skype group. He does trade every single day. He's got a lot of current clients and subscribers that are following him on Skype, and they're trading every single day, and they're very, very active, which is a nice bonus there as well for those of you that are hands-on. Okay. Here's Joe's boost your investment deal. All right. Joe wants to help you. He really does. And we do as well. We know it's tough trading out there in the market, and especially with days like we had yesterday. I keep bringing that up because we've had several days like that this year on that side of it. If you are interested, give us a call on that side of it. One of my team members and strategists on my side of it will be able to with FFR, be able to answer all your questions and go over Joe's programs with you. We are offering a 50% discount off his standard lease fees on that side of it. And if you do sign up with Target Zone with us today, and we'll offer this up until the following Monday as well. Joe knows his value. He's been in this business for 30 years, and he's very, very successful. But we will give you a complimentary Key Point program as well. All right. So really, these are some of the questions that you need to ask yourself. You know, will Joe and his opportunity be able to help me achieve my goals? Some of the goals that you have and you've been thinking about, and hopefully you've written down and you're trying to achieve with your own trading. Do I have the knowledge and time to accomplish success on my own? And maybe some of you do. Maybe some of you need a little help, and that's what Joe's here to do. You can, with Joe's support and his teaching and his tutorial, right? His tutorage on that side of it, all right? And then, can I afford to improve my own trading? You know, that's something you have to think about. You know, you got to think about, can I afford to work with Joe on this side of it? And some of you should be thinking, you know, how can I not afford, you know, to change my current status and get some better results with my own trading, okay? So this is our info, everybody. Thank you very much for joining us. Thank you for being here today on the webinar. So please give us a call, 800-883-0524. Either Alicia on my team or Laura will be able to answer your call, and they'll transfer you to one of my strategists. I got several that they trade themselves in the market. They're very knowledgeable. They're very knowledgeable on what Joe does as well, and they'll be able to answer all your questions and be able to show you how we can help you achieve your goals in trading. Okay. Thanks, everybody, and look forward to seeing you on the next one. Thank you, Joe, for joining us today and going over everything. It was very educational webinar today. All right, everybody. Have a great day. Safe trading out there. All right. Be successful.